Welcome to the Deep Dive. We're here to help you get informed quickly by unpacking source material, pulling out the key insights for you. Today, we're digging into some excerpts from a major company's 2024 annual report. We'll be looking specifically at their business segments, how they did financially last year, and their approach to shareholder value.
Yeah, these annual reports, the 10Ks, they're packed with detail, super dense sometimes. Our job is really to guide you through what's in this document, highlight the important bits. We're sticking strictly to what the report tells us.
Okay, let's unpack this then. Maybe start with the core business strategy as they describe it.
Right. So the report frames the strategy around the hybrid cloud and AI opportunity. Big focus there. It talks about a platform-centric approach, delivering value by combining technology and business know-how, integrating things like data, IT, industry knowledge, trust, security, and partners too. Exactly. And what's really interesting is how the report emphasizes that hybrid cloud platform and AI are central. They're key to helping clients with their digital transformations, finding new ways to engage customers and employees.
So it brings together software, consulting.
Right. And those crucial mission-critical systems like the IBM Z mainframes, it's all connected in their view.
And it looks like they're actively reshaping the business, too. The report mentions strategic acquisitions to boost their software side, particularly for AI and hybrid cloud.
Yeah, they name a few: Neural Magic for deep learning, StreamSets for data integration, and Web Methods for API management. It shows we're buying specific capabilities.
Interesting. And it seems they've also tweaked how they sell things over the past few years.
Yes, the report talks about that, developing more experiential sort of technical sales approaches. And interesting point, using their own tech internally first before client rollouts. Kind of eating their own cooking, so to speak.
Which really highlights this shift the document describes, moving towards being more software-led, more integrated overall.
Definitely.
There's a key stat in the report. Software was about 45% of total revenue at the end of 2024. And, get this, roughly 80% of their revenue comes from clients buying across all three segments: software, consulting, and infrastructure.
Wow, 80%. That really shows how intertwined it's all become, doesn't it? It's not just separate silos anymore.
Exactly.
And that integration connects directly to their AI strategy. The report lays out 4 differentiators they're pushing: open, cost-efficient, hybrid, and domain expertise.
Okay, can you give some examples from the report?
Sure. So they mention using Red Hat AI for cheaper inferencing and hybrid setups, developing these smaller open granite models, balancing cost and performance, and embedding specific industry expertise into their solutions.
So AI isn't just one product line then?
Not at all, according to this report. It makes it clear AI is being infused, everywhere, across all the segments. Well, they give examples like Watsonx for building AI apps, Red Hat's AI offerings like OpenShift AI, Watson Export Assistant for Z that helps modernize mainframe apps, and even their internal consulting Advantage platform, using AI to help their own consultants.
Okay, so that's the strategy and the structure. How did the segments actually perform in 2024 based on the report? What stood out?
Well, the software segment definitely had a strong year. The report shows revenue grew significantly, 8.3% as reported, or 9.0% if you adjust for currency swings.
Nice.
Yeah, they point to broad strength, but specifically call out double-digit growth in Red Hat and their automation software. Transaction processing, which was also part of software, saw strong growth too, up almost 9% reported. Both recurring and transaction-based stuff did well there.
Okay, strong growth in software. What about consulting?
Consulting was flatter. The report shows revenue down slightly, 0.9% reported, but actually up a tiny bit, 0.6%, adjusted for currency.
Is that why the flatness?
The document puts it down to a, quote, dynamic market environment. Basically, clients were being a bit more selective, maybe shifting their spending priorities around.
Right, makes sense. And infrastructure, that segment usually has its own rhythm, right? Product cycles.
Exactly. And the report confirms that. Infrastructure revenue decreased 3.9% reported, 2.7% adjusted. They explicitly say this reflects product cycle dynamics.
So things like the IBM Z mainframe cycle.
Precisely. Hybrid infrastructure revenue was down, and that includes IBM Z revenue, which dropped 10% reported, or 8.9% adjusted. The report notes this fits the timing since the latest generation, the Z16, launched back in Q2 2022, so it's later in its cycle.
Okay, so an expected dip based on timing.
That's the picture the report paints, yes. But importantly, it adds some context. It says that even with the 2024 revenue dip, the Z16 program overall has outperformed previous cycles.
Interesting.
Yeah, and it drove demand for more capacity. Installed MIPS, that's a measure of mainframe processing power, doubled over the last 2 Z cycles. So underlying demand seems strong, according to the report.
And did anything else offset the Z decline within infrastructure?
A bit. The report notes growth in distributed infrastructure, particularly storage and some of their power systems, helped cushion the blow somewhat.
Got it. The report also mentioned consulting signings,
Yeah.
sort of a forward-looking indicator.
It did, yes. But it also cautioned that these are management estimates about future revenue, involving judgment calls. So an indicator, but not a guarantee.
Right, okay. So let's zoom out then. Big picture financials for the whole company in 2024. Did overall revenue grow?
Yes, it did. According to the report, overall revenue was up 1.4% as reported compared to 2023. That jumps to 3% if you adjust for currency. And as we said, that was mostly thanks to that strong software performance.
And profit margins?
Gross profit margin improved a bit too, yeah, from 55.4% to 56.7%.
Okay, but I remember seeing something about a big jump in expenses in the report.
You did. Total expense and other income, that category saw a pretty large increase, up 16.2%.
16%. That sounds like a lot.
It does. But here's where the report provides some really crucial detail and transparency. It breaks things down into operating non-GAAP results versus non-operating items.
Okay.
And the document makes it very clear that the big jump in total expense was heavily driven by some very large non-operating items, specifically retirement-related costs.
Ah, okay. So not core operational spending driving that big increase.
Exactly. The source goes into detail.
Yeah.
There were significant pension settlement charges in 2024, a $3.1 billion one from transferring U.S. pension obligations, and another $0.4 billion from a similar transfer in Canada.
Billions. Wow.
Yeah. And the document stresses these are non-operating, non-cash, pre-tax charges. They basically came from recognizing built-up actuarial losses all at once when they transferred those pension promises to insurance companies.
So let me just clarify this because it seems really important based on the report. These multi-billion-dollar charges, the report says they didn't actually hit the company's operating earnings, the non-GAAP ones, or their cash flow.
That is precisely what the document states. It draws a clear line. Operating retirement costs are, the ongoing costs of service. Non-operating covers things like market fluctuations, interest, expected returns on assets, and these big one-off actuarial gains, losses, and settlements.
Okay, that context makes a huge difference. So forget the big total expense jump for a moment. What about the operating expense increase, the non-GAAP one? How much was that?
Much smaller. According to the report, operating non-G expense only grew 1.8%.
And what drove that smaller increase?
The document mentions a few things. Some workforce rebalancing charges tied to productivity efforts. And notably, a big jump in R&D spending, research, development, and engineering expense was up over 10%.
Investing in the future, then?
Looks like it. The report ties that R&D spending to investments in AI, hybrid cloud, quantum computing, and also getting ready for the next IBM Z cycle, which they expect in 2025. It also notes a rise in income from intellectual property and custom development driven by semiconductor deals.
Okay, so connecting it all back, how did those big non-operating charges affect the bottom line, the reported profit?
Well, because those charges were so large, the report shows income from continuing operations before taxes took a big hit, down 33.3%. And that flowed through, naturally, to lower reported net income and lower reported earnings per share. Both were down about 20% compared to 2023.
Right. Okay. Shifting to the balance sheet. What did the report say about their overall financial position at year-end? Stable. Flexible.
The report paints a picture of strength and flexibility. Assets were up slightly. Liabilities actually decreased, leading to a significant jump in equity up over 20%.
How about cash?
Strong cash position highlighted in the report. Cash and marketable securities increased by $1.3 billion, ending the year at $14.8 billion, and total debt came down by $1.6 billion to $55.0 billion. So more cash, less debt.
Good combination. Now, cash flow. Always a key metric people watch. How did that look in the report?
Okay, so cash from operating activities was actually down slightly. The report shows $13.4 billion in 2024 compared to $13.9 billion in 2023.
Why was that down?
The source mentions fluctuations in financing receivables had an impact, though improvements in net income before those big non-operating items helped offset some of that. And this is a big but in the report, free cash flow, which the company clearly emphasizes, that increased significantly. It went up by $1.5 billion to reach $12.7 billion.
Okay, so operating cash down a bit, but free cash flow up quite a bit. How does the report explain that difference?
The document attributes the free cash flow increase to two main things: underlying performance improvements and what it calls sustainable lower cash requirements because of those changes to the retirement plans, specifically the pension transfers.
Ah, so those big pension deals had a positive impact on free cash flow, even if they hurt reported income.
That seems to be the key takeaway from the report's explanation. It's changing the structure of how cash moves through the business.
Interesting. Did the report mention much about investing and financing activities?
Briefly, yeah. On the investing side, they used a net $4.9 billion. That included $3.3 billion for those acquisitions we mentioned earlier. They also gave some cash back from divestitures, like selling off some QRadar cloud assets.
And financing, paying down debt.
Financing activities used $7.1 billion net. The report says this was mainly because they issued less new debt than usual, and they had more debt mature and get paid off in 2024.
Got it. Any other sort of financial footnotes or details worth mentioning from the report?
It touches on a few other areas, things like needing management judgment for allowances on financing receivables based on the economy, the status of uncertain tax positions, currency impacts, which the report said trimmed pre-tax income growth by about $100 million in 2024.
Any legal stuff?
Yeah, it mentioned resolving some significant legal cases involving BMC, Global Foundries, and a pension lawsuit. The report indicates that based on the info available, these didn't have a material financial impact or had favorable outcomes for the company.
Okay, so let's try to pull this all together then. We've got the strategy, the segment performance, the kind of complex financials with those big non-operating items, the balance sheet health, the cash flow story. What does the report suggest this means for, say, someone interested in shareholder value?
Well, the source material is pretty direct on this point. It explicitly states that during 2024, the company returned $6.1 billion to shareholders through dividends.
$6 billion, okay.
Yeah, and they present this as clear evidence of their commitment to distributing value back to the owners of the company.
And I guess that strong free cash flow generation we talked about is what enables that, right?
Absolutely. The report connects those dots. It notes their ability to generate cash allows them to keep investing in innovation, in R&D, and acquisitions, and simultaneously return value via dividends. It's presented as a core part of the financial model.
Did the report show how the stock itself performed?
It did. It includes those standard performance graphs comparing the stock against the S&P 500 and the S&P Information Technology indices over 1, 3, and 5 years.
And how did it stack up?
Important note first, the source says these graphs assume dividends are reinvested, so it's total return. Based on that, the graphs show the stock outperformed the broader S&P 500 over all 3 periods, 1, 3, and 5 years. Compared to the S&P Tech Index, it outperformed over 3 and 5 years, but slightly underperformed just for the 1-year period ending 2024.
Interesting context. So wrapping up, what's the overall message from the report about the path forward? What's the outlook?
The report basically says, stick to the plan. Continue focusing on that hybrid cloud and AI strategy. Keep integrating the acquisitions they've made. Manage the portfolio, maybe more deals, maybe more divestitures. Keep investing in R&D for the future. And critically, keep generating strong free cash flow.
And that cash flow fuels.
Both things, according to the report. Fueling the strategic investments and continuing to return value to shareholders through dividends. They also acknowledge, the ongoing market dynamics affecting consulting and managing those infrastructure product cycles we discussed. It's not all smooth sailing, but the strategic direction seems clear from the document. So if we recap the key takeaways from digging into this report, you've got a company really zeroed in on hybrid cloud and AI, shifting its model towards software and integration. Performance-wise, software was the star in 2024, helping balance out challenges elsewhere from market conditions or product cycles.
And the financials.
Yeah, the financials show reported income took a big hit from those non-operating retirement charges, but the report emphasizes strong free cash flow generation. That's presented as proof the underlying business is healthy and converting activity to cash, which supports their dividend commitment.
It definitely paints a complex picture from the source material, managing a huge company through strategic shifts, market ups and downs, those significant kind of unusual financial events, and trying to generate enough cash for everything. Reinvestment and shareholder returns. Which leads to maybe a final thought for you, the listener, based on what this report showed us.
Yeah.
Given just how much those big non-operating items, like the pension settlements, impacted the reported bottom line, how might focusing primarily on the company's operating performance or maybe its free cash flow numbers the report breaks out specifically give you a different, maybe even a clearer perspective on the core business's health and momentum compared to just looking at that final reported net income figure. It's something the report itself seems to encourage you to consider.
Well, we hope this deep dive into these annual report excerpts has given you some valuable insights.
Yeah, and if we sparked your curiosity, definitely feel free to dig into the source material yourself. Thanks for joining us today.
Look forward to the next deep dive.